Welcome everyone. My name is Lukasz. I'm Executive Director and Chief Investment Officer at Lonsec. Very pleased to be able to host this webinar today on crypto assets. And today's topic will have a bit of an advice slant. We have had a lot of feedback from the advice community around what are some of the practical advice considerations around crypto assets in general. Just before I introduce Craig, just a couple of housekeeping items. First and foremost, just in terms of format, the format will be a fireside chat. I'll have a conversation with Craig. We'll cover a range of topics and issues. Please hold, if you have any questions, use the chat, the questions box. We'll have the Q&A at the second half of the presentation. So about half an hour of a discussion, followed by Q&A, and hopefully we'll be able to address most of the questions. If there are any questions that remain unaddressed, we will endeavour to get back to you post the presentation. So with that, I'd like to introduce Craig Hobart from Monochrome. Craig is the Head of Distribution and Strategy at Monochrome, and I've known Craig for I think probably about 20 years, I reckon.
Yeah,
close to. Craig has a very interesting background in asset management, very much, I guess, focused on fundamental asset management, having been managing director of organisations such as Nikko Asset Management. I actually met Craig at Deutsche Asset Management. Craig's also had vast experience in the superannuation world as well. So very well credentialed in terms of I'll sort of say traditional investing. And so what was interesting is I sort of ran into Craig a little while ago, and it was somebody told me he's involved with crypto assets, and I was like, okay, well, what's going on here? So maybe Craig, if you can maybe give a very high level overview of Monochrome, who they are, and then after you've done that, I'd be keen to understand, how does a person like yourself, like most of us on this call, very traditional financial background, how'd you get into crypto?
Sure. Okay. Well, let's deal with both of those questions. The first is I'll just introduce Monochrome and what we're doing. So we recognise there's a real problem in the market about an unregulated asset. Well, there's lots of mums and dads and your clients, the advisors' clients, that have been involved with crypto in some form, and we've seen people get their fingers burned. It's a Wild West. We see that as a problem. And also a lot of money is lost in the ramps going in and out of the asset class itself. So we saw that there's an opportunity here to do a couple of things, is to provide safe custody, provide safe access to the asset class through traditional investment structures, which you would become aware of. We have managed investment schemes available as a primary purpose. But then additionally, we recognise that the advice industry needs a lot of help. We ran a survey late last year. 77% of advisors had taken inquiries from their clients, and only 11% felt that they were equipped to respond to them. And there's for a range of reasons for that, and we wanted to help solve some of those. Access to a product they could apply is important. Education's key. So we think that it's like asbestos gloves when you pick up this asset class. You really need to be careful. So we provided CPD content as well. So that's what Monochrome's doing. It's not just the product, but it's the things that we see the advice industry as a white knight in this event, and we want to support the advice industry and give them the tools that they need. This asset class is not for everyone, and that's absolutely important. We all know that, and so we're providing the right platform for a safe place for advisors to get objective content. So the first thing you do when you Google a lot of this stuff is there's a lot of material out there. And we all know that Google isn't necessarily telling us the truth these days. So we're being quite careful about how we're positioning the material so that advisors can have an objective view. So a bit about why I got involved. Well, you're right. I've had an intrinsic value or a traditional fundamental-based investment background all my career, and a couple of things occurred to me. One was I saw this nascent asset class needed some guidance or some help. And the opportunity to help Monochrome deliver that appealed to me. I've been consulting for a couple of years, and there are, the three things that kept coming up in my environment was alternatives, ESG, and digital assets. So interestingly, this one to me is one that I've developed obviously a closer relationship, and in fact joined the business in the middle of last year. In terms of how I've got my head around it, the reality is the first thing you have to do is recognise it's not an intrinsic valued asset. And the beauty of this is actually, certainly I'm talking about Bitcoin in particular right now, is it's not related to interest rates in any way. So everything else that we all have enjoyed, all boats have risen with declining interest rates for 30 years. It's been a wonderful experience for us all through markets ups and downs, but net, we're all at record highs. What happens next is a great question. So there was an interesting thing for me. It could possibly solve a problem for the advisor and for clients as one option. I'm sure, Lukasz, you'll expand on that later. But that appealed to me, and also just accepting that this is not intrinsically valued. It's obviously sentiment driven, and then understanding the drivers of that has been quite a journey. And we'll talk a bit more about that later.
Absolutely. Absolutely.
Okay,
Sorry,
back to you.
Go on. Yeah, all right. Well, we'll move on maybe just a little bit into the sort of, I guess, looking at sort of some of the growth drivers in terms of digital assets more broadly, and obviously Bitcoin being a key part of that. We've seen, if you sort of cast your mind back a few years ago, certainly sort of in the early days, crypto had a sort of was associated with criminality, basically. The dark web and so forth, and obviously things have changed quite dramatically over time, and the size of the market is grown exponentially over the years. What do you think some of the factors? What factors do you think have contributed to that growth? And what are sort of some of the trends you're seeing in terms of adoption into different parts of the market, where maybe it's a little bit different than it was 10 years ago?
Yeah, sure. We might just move forward a slide as well. There's a couple of things in all of that. I mean, Bitcoin, as you know, was started in 13 years ago. It was an idea about a peer-to-peer payment system, a handshake, like we do physically with cash when you transact, but doing it through the internet. Cyberpunks, as they were called, were the early adopters. And then you're right, it did go into a dark place where people saw it as a way of moving assets and defrauding people. Had a dark time as well. I mean, what's happened since then is the evolution of exchanges, both good and bad. The good being the facilitation of access to the asset, the bad being obviously the challenges of exchanges being unregulated and gamification that's embedded in those apps. They make money out of transaction volumes. And then what we've seen more recently is, of course, I describe it as the suits coming into the space. So large institutions, the regulators are paying attention. We've seen the successful launch of ETFs in Canada, futures priced ETFs in the United States, and in Australia, we've got, ASIC has now recognised that there are only two assets that meet the standard of proof for being a digital asset inside a PDF structure, and that's Bitcoin and Ethereum, and we'll talk a bit more about that later. So it's been an interesting evolution, and Bitcoin has been the foundation rock of that experience. And then more recently, we've seen innovation and continue to see innovation. As it is the Wild West, and a lot of it's unregulated, that's also where the hyper risk is, trying to distinguish between a good idea and a fraud. That term rug pulling, where pump and dump, as it used to be in the penny dreadful equity space. So it's a very interesting time for the sector. In saying that, it's also establishing itself. So this chart here just shows the significance of Bitcoin now. I kind of smirk and smile, and I'm sure a lot of our listeners would as well, because number 11 on the list, Bitcoin, is 700 billion. Number 11 is Berkshire Hathaway. So and we all know Warren Buffett's view on crypto. So interesting in itself. So it's forced its way to relevance. It's a real, when I say a real asset, it's garnered a lot of asset growth, as we can see. And then inside the ecosystem of digital assets, the next slide really just shows what's happened in terms of the ecosystem of digital assets itself. So if we could just move forward to the next slide. We can see Bitcoin still dominates. Ethereum has taken also a reasonably dominant position, and then you can see there's a tailing off of currency, and then other is a lot of the innovations around the space that has occurred. NFTs, DeFi, etc., etc., and that's a very interesting space as well.
So, I mean, yeah, we've definitely seen, I guess, the suits, as you call it, get increasingly interested. I think, you got some big names out there. Visa is one where obviously it's got crypto on its network. BNY Mellon has got a whole digital assets unit and obviously providing custody on digital assets. And even, as you say, some of the, I guess, people that have been skeptical are now sort of a little bit more open-minded to at least considering it and acknowledging it and doing more work into it. So I know JP Morgan's come out and Citadel, another example. But I guess, I mean, one of the more interesting ones, I guess, from a domestic perspective was CBA's announcement that they're looking to enable customers on their app, basically on the banking app, to access crypto assets. I mean, just your initial thoughts on that. I mean, do you think that sort of trend will continue? I mean, I think a lot of people were surprised that, I guess arguably a conservative domestic bank went down that path.
Yeah, so it was a very interesting move by CBA, and you'll notice there's a disparity of views across the other three major banks about what they're going to do. Some have outright said never. But others are looking at it. It just proves up that it's an asset class that's it's a nascent asset class. It's finding its way into the ecosystem of investing, CBA has seen there's obviously customer demand. I mean, the interesting thing about this asset class, as we both know, is it's upside down in terms of its evolution. Traditionally, investment ideas start in the institutional space and then migrate down into consumer consumer visible access points. This has been a complete reverse experience for everyone. So it started as a novel idea and then became broadly consumer driven, and it's now finding its way. And of course, Bitcoin and Ethereum and others, their purposes within portfolios is still in discovery. So one advocate, one view of Bitcoin is that it's a hedge against market collapse. It's a long vol solution, possibly a hedge against inflation. Obviously, there's been a risk off trade that's occurring across all assets at the moment, and it's caught up as all assets are caught up in that at the moment. But as we come out the other side of it, we'll see what its purpose is. So in the institutional space, people are seeing it's possibly as a solution, and I know you'll touch on that in a moment, Lukasz. But also there's just a lot of demand from the consumers to, if they're going to have exposure, I think the advice industry can provide guidance on, if you're going to touch it, how do you control it, use it, and we'll talk more about that in a moment.
Absolutely. Maybe if we move on to, I guess, accessing cryptocurrency. So, I mean, obviously that space has evolved over the years. I mean, many years ago, it was very difficult to buy crypto assets. You had to fill out a form, you had to answer a whole bunch of interesting questions going back, say, 10 years ago. Obviously, we've had the expansion of exchanges. I mean, there's a variety of ways you can access it. And there's more complexity to it. And I think obviously with the advent of ETFs and fund structures coming into the fore, certainly in the wholesale space, but also in the retail space, it's going to add another, I guess, way of accessing. So maybe if we can go through, number one, I guess, just to recap how people are accessing crypto, because no doubt there's a lot of advisors out there that their clients may have crypto. They may be most likely access it through an exchange. That whole world is evolving. So maybe if we can sort of go through key access points and I guess some of the high level pros and cons, because interesting with the ETF structure coming on online at some stage, interested to discuss sort of the pros and cons as well.
Yeah, so thanks, Lukasz. It's a question that came through from your audience as well. So we put together this slide to explain it for you. And so I'll just work across this slide that people can see from left to right. So exchanges are very convenient, is the pro. They're very quick to set up. You can set up an account in a few minutes on an app. So on your phone, and they're obviously primed with innovation. They're thriving in that environment. That's the positives. The cons are that, of course, they are unregulated. So what does that mean? It means if an exchange collapses, you lose your money. There's no trust accounting. There's no protection of the investor's asset. In actual fact, you don't own the Bitcoin, for example, when you're on an exchange. The exchange owns the Bitcoin, and they promise you that they have your exposure in a ledger somewhere. So the pros are convenience. The risks are clear, unregulated, and they can be hacked. And there, to some degree, there's a lack of price transparency as well, because you get the price that they offer. And that's also where a lot of the noise and news has been, as we all know. Hacks, collapses, defraudment, all those kind of things have occurred in that space. So yeah, eyes wide open if you choose that path. So what people have done is they might engage through an exchange and then decide to migrate to the next section, which is self-custody, and that's where you take your exposure off the exchange and have your own wallet. You become your own bank, and you have complete control. Now that's both good and bad, isn't it, if you have complete control, because the risks are, and we know, for example, in Bitcoin, over $120 billion has been lost forever because people have lost the keys to their account. And it's not like our phone or any other device where you can just say please, please, and there'll be a service center that'll give you a new password. It's gone because you are the owner of that responsibility. And of course, also if something unpredictable happens in self-custody, for example, you get hit by a bus, or there's some event, life event, and you're the controller of that asset, it's lost again. People lose control of it. So we might just go back to, if you don't mind, we've just jumped a slide. I'll just continue across if you don't mind. So the next area is proxy. So that's self-custody, and we'll talk about wallets in a moment. Sorry, that was great. The proxy is basically where while we've been waiting for regulation, there's been proxies or ways to kind of, in a synthetic way or an alternative way, get exposure to the story or the event or the macro theme. And that's been through traditional managed funds that have exposure to the pick, spades and shovels of the sector. And as you know, there are a few managers that are operating in that space. And they also are making a promise of some form of alpha. And the challenge will be whether that's luck or whether it's skill. And I'm not saying it's one or the other, but in some instances, it's too early to tell. We need time for those managers to settle into their processes to prove up. The cons obviously are, or the negatives around the proxy is obviously when you're investing in pick, spades and shovels, you've got a higher beta exposure to markets. And one of the fundamental things about Bitcoin is its separation from other assets, because it doesn't have an intrinsic, it's not in any way related to interest rates like every other traded asset is, almost every other traded asset is. So the cons are, or the difficulties are, when you're looking for it as a diversifier, you give up some of that as soon as you use a proxy, as it were. And then the final section on the slide is managed investment schemes, and that's where the advice industry, they can operate in the proxy space, by the way, but also managed investment schemes and ETFs as they develop. So on the 29th of October, ASIC gave guidance. They did CP343 in July, which was an engagement about, well, what do we do with this nascent asset class? How do we regulate it? And then they came back with guidance. And it's the first time that they've given guidance, and the first time they've allowed that a PDS can be issued in this asset class. I mentioned earlier the two assets that have come through the gate in terms of suitable for a PDS is Bitcoin and Ethereum. And their criteria are things like, is there a deep liquid spot market, a developed futures market? Is there institutional support, service provider support? Is there custody available suitable to protect consumers inside that structure? So ASIC had to make some concessions as well, because traditionally they don't allow a PDS to be issued unless there's a domestic custodian. Well, in this asset class, there isn't a domestic custodian that can provide the service. So they've just asked that the custodians provide the degree of skill and service and compliance required to be the equivalent of a domestic custodian for the use of this asset class. So the advice industry will see in the next quarter PDSs emerge, and also the ETF market. So the ETF market, there's two processes occurring simultaneously there. The first is REs need to get an amendment to their license, and we're participating in that process to be allowed to have digital assets in their license. And that's a very important step. And then there are other things like they require PI cover, the custody piece, and we, and others have to go through the Australian Stock Exchange, ASX, first as a filter, meet their requirements before ASIC then issues and approves ETFs. So we'd expect that to occur over the next few months as well. Now, the cons, and there are there's pros and cons on all of these structures. The cons are that you don't have direct holdings of the underlying coins because it's like a trust structure, and it's like when you buy into a perpetual industrial share fund, you don't own the shares. Perpetual does, and you own them through a unit trust structure. You own units in the fund. So, and the other thing worth noting is the difference between spot and futures price products. I know a lot of the advice industry can't advise on futures-based ETFs. Where our preference will be spot. There's also a performance arbitrage or performance difference between the futures and spot market, spot being better. So that's just something to be aware of as these products develop as well. So that's
and just an interesting one, just a sort of something I've been thinking about as you've had, and particularly as we see sort of the MIS and ETF structure coming into more prominent, I guess. If you sort of track back and you think about one of the concepts or sort of around crypto, and certainly one of the aspects that the true believers have sort of highlight is its sort of decentralized model. And I guess with that, it's that you're sort of cutting out middlemen, you're reducing friction, etc. Now, with an MIS or ETF sort of structure, you could argue actually it sort of goes against the fundamental sort of ethos of what the true believers say. How would you respond to that?
Well, it's a great question. It's like when you employ a managed fund, like we use that perpetual example, they obviously have a governance responsibility to front at shareholders meetings and represent their unit holders. And they vote as they see as appropriate in the interests of their unit holders, not in the interests of themselves, but in the interest of the unit holders. So I see it as applying in the same way. So, as the trustee of these assets, we would vote responsibly in the interests of the underlying unit holders. In saying that, it's also worth noting that it's a very diverse decentralized. It's the most decentralized asset and structure in the world, the Bitcoin, and no individual has control, and it's near impossible, arithmetically near impossible for anyone to seize control of the protocol. So it's an interesting thought, but it's not we wouldn't consider it as a high risk for investors. But you're right, to the Puritan, direct ownership of your Bitcoin is the purest way for you to have. Having a node is the most purest way to having a participation in the process. Yeah.
And I think just if we try to track back, I think there's a few. If we sort of go back and there's different, I guess, levels of exposure to Bitcoin. Just go through the wallet concept, maybe in a little bit of detail.
Yeah, so that is the next slide. And again, thanks to those that asked that question before the call today. So that gave us the opportunity to prepare this for you. And this content will be available for you afterwards as well. So if this is useful for you in describing it to your clients, we welcome you to use it. So a wallet is a way of you actually holding your coin, your Bitcoin. And a hot wallet are very easy to set up. They're usually free, and exchanges provide them and other providers, and very easy to transact. Now, a hot wallet, hot and cold, I'll just explain the difference for those that aren't aware. A hot wallet means that you're connected to the internet. And of course, as soon as you're connected to the internet, you have to be careful, because that's where hacks occur. That's how people interfere with or try to get into your account and steal your coins. And invariably, that's where a lot of the fraud occurs. And we talked about we're providing a safe solution. The ramps in and ramps out of Bitcoin are where the risks are. The protocol itself is robust and safe. It's the ramps where the risks occur. So the hot wallet is convenient, but it has risks around it, the risks of hacking. A cold wallet is where effectively it's like a USB stick. You basically, equivalent thereof, you take your exposure and you take it off the internet. And it's cold because it's not connected. There's an air barrier between your wallet and the internet. So they usually cost, that technology and those solutions usually cost a couple $100 to set up. So obviously less convenient to transact because you've got to reconnect into the environment and out of it. Custodial wallets is what where we spend our time as a fund manager is basically using the services of the digital custodian to provide a segregated wallet for us, so that when we transact, we put our investors' money into our segregated wallet in cold storage. And for those that don't know, the environment for digital custody is quite interesting. They actually reside in bunkers, predominantly in the United States, that are airtight, layers of risk control to get into the room where the actual where the custodian wallets are held. So there's an explanation of the wallet environment. I hope that's helpful, but happy to take any other questions if they come up.
Yeah, no worries. Maybe if we sort of pivot to this sort of advice component, and I know there's a lot of sort of ambiguity at the moment as to, clients are coming in to either already holding crypto assets, interested in crypto assets, or simply just their neighbours said they've made a fortune and sparking, what do I do? Do I invest in this sort of asset class? But I guess from an advice perspective, and obviously on your side being a product issuer and going through this process, interested to just sort of go through how have you thought about how to, if you're going to launch a product in the advice space, what are the key things that you've got to consider? Things like regulation, we can touch on all these things like PI, insurance, etc. How do you sort of think about it from an advice lens?
Sure. So let's start with what's occurred. We touched on it earlier. So, middle of the year, ASIC engaged the market, which is really helpful with CP343, and then there was Response 705, which came out in late October, and it provided the framework for which a PDS can be issued. Now, that was profoundly important for the advice industry because it meant that suddenly this asset class is now technically is regulated, not unregulated. Certainly in relation to Bitcoin and Ethereum, if packaged in a managed investment scheme, whether it's unregistered or registered, and the ETF environment. So the first step was the regulator providing an outcome that is usable for the advice industry, and that's been delivered. So the next evolution will be the retail PDSs being, as I mentioned earlier, coming into existence, and ETFs, and us and others are going through that process of getting those certifications. As it is today, we have the highest level of access in terms of a managed investment scheme, unregistered. A wholesale fund was the best structure that we could offer the market until that occurred. So that's the first thing. The next is obviously for embedded in advice businesses is a research rating. So that process is starting, and Lukasz, I know you may talk about what your plans are for the sector later, but research ratings are important so that you can then apply it to an approved product list, and then as an investment committee in consultation with your asset consultants, work out, well, where do you put it? So the leading example, or when I say leading, not leading in terms of it's the right thing, but one of the first movers was Raise, which used to be called Acorn. It's a micro savings product, and they produced an aggressive portfolio with 5% exposure to Bitcoin and called it the Sapphire option. So very transparent on what it was, and that's proven to be very popular with the millennials in their database. So the APL process, it's the same process that you all go through when you have a new asset or a new product that you want to put through into making it available for your clients. So then you need to consider your model portfolio weights. PI cover, just a side note, but critically important, is the policies usually are silent on crypto. Where you'll find any wording is in the endorsements. So it's very important you have a look at that and bring it up at the appropriate time with your underwriters through your brokers. And we're also there to stand and support that. In saying that, we think that if you want to risk mitigate as a licensee, there's a few things you can do. The first is have accreditation. So that's why we developed the CPD content. So that if you start, for example, in the Bitcoin environment, we've put together a really nice series of content that will then allow the advisor to appropriately respond to the inquiry that they're getting from their clients and have some reasonable understanding, certainly how to use it. This is a bit controversial, this next point. how much are you willing to lose? And that's a really important way. As I said, it's not for everyone. And I think you really make the customer stand in their shoes when you ask them that question. And certainly in the United States, and we look, because they're ahead of us in terms of this, they've been advising in this asset class for a while, and you guys would be aware of that. You would be looking, as you all do, as to where best practice is or leading practice. So they're saying, as also I've mentioned at the end, a 1 to 5% exposure is about where they draw it usually from the alternatives bucket. It's the most obvious place to do it as well. And the other way that you can mitigate the risk is, as you do with certain products, when you have an SOA that's touching something that you think is sensitive, you get compliance to pre-vet it before it's implemented. So as opposed to the traditional auditing of post-implementation SOAs, in certain circumstances, you take the time to pre-vet. And we think with that framework, that's so what it does mean is advisors can start considering it if they go through that sort of checklist. It's not advising you, but they're the kind of things I would be thinking about and appear to be what licensees are telling us are the challenges or the opportunities that present through this process.
And from a regulatory perspective, I mean, you mentioned already, you touched on some of the recent sort of changes. I mean, I guess given in that product space, I mean, do you foresee where's the next sort of key area, do you think, from a regulatory perspective, that there might be a focus on in this in crypto assets?
I think the next area, the first thing is ASIC has said there are only 2 that come through the gate and they'll review in 2 years. So there's sort of like it's a trial almost, if you will, and then we'll see how the asset class evolves. So if other assets meet that strict criteria that ASIC's put out, they'll start to be included into the space as well. So that I'd see that continual evolution to occur. The other area of regulation is exchanges. So the Andrew Bragg's report that came out in the 3rd quarter, 4th quarter last year also made some strong recommendations, which we support, about the regulation of exchanges. So they have to start meeting the duty of care that a custodian would. In other words, come into the environment of regulation. So, so there will be development in terms of the exchange end of that spectrum of how you access it over the next 2 years. And the other area which is becoming important is the knock-on effect is APRA. So them reviewing the requirements. If a bank is to offer something in this space, what are the Basel requirements and so forth. So you'll start to see, I think, the evolution of legislation, certainly, and policy from APRA. And there are other jurisdictions that we need to consider as well. So, you know, the United States, the SEC is stumbling over issuing spot ETFs. ASIC has made it clear that that's a pathway because they've required us to have a custody provider, and that's only required in that sense in the spot price market. So, and then you'll see some nation states, as you've seen, El Salvador on one end of the spectrum, as they don't have their own currency. So this was an opportunity for them to separate from the US dollar. That's one, and that's been very popular with their population. More people have a wallet and access to Bitcoin than there are bank accounts in El Salvador now, and that's happened in the first 60, 90 days of it occurring. Then you've seen China ban mining, and that didn't impact the Bitcoin protocol. You know, a lot of that mining migrated to the United States. And then you've seen now Russia is starting to make noises overnight about what to do with crypto. And of course, the more centralized a government is in terms of its outlook and its philosophy, the more that this will be threatening to them, I think, because this is a decentralizing event. So that's interesting. Inside Russia, there's over 200 billion in crypto. So it'll be very interesting to see how they navigate that. And it's obviously a very sensitive part of the world right now.
Absolutely. I think actually when China banned crypto, I think some of the miners moved over the border actually to Kazakhstan. And
that's true.
For those that have been paying attention to sort of geopolitics, obviously Kazakhstan was a bit of a focal point a few weeks back. So it does seem to be fairly mobile and dynamic in terms of the whole mining ecosystem. Just, I guess, just a quick note on the you mentioned research. So just for the advisors out there, obviously once we do see product come to the market in the sort of the wholesale space, the place we play in, we will be looking to rate those products in terms of the research side of the business. So there's been a lot of work being done behind the background to sort of around this asset class. So just a note there. So maybe just before we get to Q&A, final one around portfolio application. So, you know, there's you know, how do you access it? I mean, what is it? I mean, you know, what are the key considerations from an advice perspective? But then you know, you touched on, you mentioned alternatives. You mentioned that some of the guidelines, I guess, out there in the US in terms of sort of types of exposures. I mean, I'll give you sort of, I guess, some of my initial views as we go on to it, but just interested in some of your observations to date on terms of portfolio application.
Yes, so we're really encouraged by what we're hearing. So there's a couple of things inside of that. One is this idea of long vol, a solution to this, you know, all boats have risen with interest rate declines, and a separation from that. So we are seeing people thinking about how they can apply it in a portfolio sense. So we think that's important. We're also seeing that the volatility is obviously very high, and there's a chart that's just popped up there that just shows if you had 5% in it and you're disciplined about reweighting, rebalancing monthly, how much you could have delivered over the last few years, and the 1% as well. When you look at the 1% no exposure, the volatility is almost identical. So that discipline around rebalancing, and for an advisor, it might also mean dollar cost averaging to build an exposure, is a really appropriate way to kind of dampen the volatility effect of the exposure. The other thing worth noting is I did see a great paper by Fidelity Digital that came out about 2 or 3 nights ago, and they really encouraged the institutional market that Bitcoin is a great proxy for or is a great exposure in itself, while the rest of the ecosystem develops. So they're seeing Bitcoin as more mature and established, and it's an appropriate place to start. And then, you know, it'll evolve from there. So we're seeing, in some sense, some would say Bitcoin is, if you just forget that all traditional asset classes, in just a moment we're in a metaverse. Let's just imagine that for a moment. That, you know, Bitcoin is almost like a bond exposure. Ethereum is, you know, a listed equity exposure, and then all the other digital assets are VC, venture capital, and, you know, the unlisted emergent space or alternative assets. So if you think of the ecosystem of digital assets, that's really what's occurring, is that's how it's progressing. So, you know, we would expect, you know, inside the Ethereum protocol, there's obviously a lot of innovation occurring as well, you know, DeFi, NFTs, etc. Stable coins, there's a whole bunch of things that is occurring in the Ethereum protocol. So it's an ecosystem in itself that has all of these variant applications built into it.
Yeah, no, I think it's interesting. I mean, I've sort of had a bit of a play around just looking at sort of some preliminary information, data, just seeing what different allocations would bring to a portfolio. So some of the analysis we've done is sort of say, hypothetically, let's say you've got a traditional 60-40, you know, equity bond type portfolio, and if we took the 2%, 5%, 10% out of equities and put that into Bitcoin, I mean, obviously this is looking at historical performance and then looking at what it does from a risk return perspective, and the overall sort of absolute return perspective, absolute volatility perspective. It's quite interesting. I mean, intuitively you think it would add a lot of volatility to the portfolio, but because it tends to bring a fair bit of idiosyncratic risk to the table, it actually benefits from if you look at, you know, if you're looking at metrics like Sharpe ratios, for those that are into all their sort of ratios and so forth, it actually is additive to a portfolio at that sort of 5-2% level. But again, that's obviously looking at historical data. Obviously, Bitcoin has had a good run, but I think initially, I think, which is worth exploring a lot more, and there are numerous papers on this, is sort of the idiosyncratic risk aspect, asymmetry of returns that the asset class does exhibit. So I think it's interesting to explore, and then obviously it's going to evolve over time. But at least it's important to actually understand how it's behaving and how it sort of operates within the context of the portfolio. So that was pretty much wraps up the formalities in terms of the fireside chat. Thank you, Craig, for some of those insights and discussion.